Welcome to the new era of high finance, where the ultimate goal is no longer the public bell ring. For decades, the initial public offering, or IPO, was the finish line for every ambitious startup. It was the moment of validation, the path to liquidity, and the birth of a public titan. But today, that finish line is moving, or in some cases, disappearing entirely. We are witnessing a fundamental transformation in how the world's most valuable private companies grow. The term unicorn was coined back in 2013 to describe startups valued at over $1 billion. At the time, they were rare, mythical creatures. Today, they are a global herd of over 2,500 firms. With a collective valuation exceeding $5 trillion, these giants have massive economic gravity. However, instead of rushing to Wall Street, these unicorns are choosing to stay private longer. Some are even choosing to go private again, a phenomenon known as the Reverse IPO movement. This shift is redefining the entire life cycle of the modern corporation and its relationship with the public. To understand where we're going, we first have to look at the golden era of the public markets. In the 1980s and 90s, the path from garage to the New York Stock Exchange was swift and predictable. The median age of a company at its IPO back then was just 6 years. Companies like Amazon went public in 1997 after only 3 years, valued at just $438 million. Back then, the public market was the essential launchpad, the primary place to get capital to scale. Public investors were willing to bet on young, high-growth companies with little more than a vision. Today, that median age has more than doubled to over 15 years, and the stakes are much higher. Companies are now reaching massive scale, tens or even hundreds of billions, while remaining in private hands. This late-stage IPO reality means companies are much more mature by the time they hit the public ticker. By then, their most explosive growth phase and the associated wealth creation is often already over. So what changed? Why is the public market losing its status as the natural final stage of growth? The first reason is the staggering abundance of private capital, often referred to as dry powder. This dry powder refers to committed capital that has not yet been invested by PE and VC firms. Global private equity and venture capital firms are sitting on a record $2 trillion in uninvested cash. This mountain of money allows private companies to raise mega rounds that were once only possible via IPO. In 2024 and 2025, firms like SpaceX and OpenAI raised billions in private rounds at astronomical valuations. Elon Musk's SpaceX, for example, is valued at nearly $400 billion and remains entirely private. Similarly, OpenAI secured a $157 billion valuation, bypassing the need for public funding. When you can raise $1 billion in a single afternoon from a handful of firms, why go public? Private markets are projected to grow to $20 trillion by 2030, providing a long-term alternative. This abundance of capital was fueled by a decade of low interest rates, pushing investors into private assets. Now, the infrastructure for these mega rounds is permanent, even as rates fluctuate. Beyond just raising money, companies also need to provide liquidity, a way for employees to cash out. Historically, the IPO was the only way to allow early investors and staff to sell their shares for cash. But the rise of sophisticated secondary markets has solved this liquidity problem for unicorns. Specialized platforms like Forge Global and Equity Zen allow private shares to be traded like public stocks. Private secondary transaction volume hit an all-time high of $152 billion in 2024. Companies like Stripe have used tender offers to allow their employees to sell shares without an IPO. In 2024, Stripe completed a tender offer that valued the firm at $65 billion. This allows the company to reward its team while avoiding the massive regulatory burden of being public. For many founders, this is the best of both worlds: public-level liquidity with private-level control. The secondary market is now nearly half the size of the primary venture capital market. This creates a parallel economy where value is exchanged without the public ever seeing a ticker. The regulatory burden of being a public company has never been higher or more expensive. Since the early 2000s, laws like the Sarbanes-Oxley Act have added millions in annual compliance costs. A public company might spend $2 to $5 million every year just on audits and legal filings. But the cost isn't just financial, it's also strategic, the problem of short-termism. Public markets demand quarterly earnings reports, which often force CEOs to focus on 90-day results. This pressure can hinder long-term innovation, as R&D spending often hurts short-term profit margins. For a company building deep tech or AI, the volatility of public markets can be a dangerous distraction. Being public also requires disclosing sensitive competitive data, like strategic partnerships and margins. In the private realm, companies can iterate, fail, and pivot away from the prying eyes of competitors. Privacy allows for a move fast and break things mentality that is hard to maintain under public scrutiny. This cloak of privacy is often cited by CEOs as the single biggest advantage of staying private. But what about the companies that are already public? They are also looking for an exit. A significant development in 2024 and 2025 is the take-private trend, led by private equity giants. Firms like Blackstone and Silver Lake are buying out unloved public tech companies to delist them. Many companies that went public during the 2021 boom saw their share prices plummet as rates rose. PE firms see these as bargains, assets that can be fixed or retooled better in a private setting. This is often called a valuation arbitrage, the idea that a company is worth more private than public. In 2024, Europe alone saw a record 95 take-private acquisitions, a sign of the growing trend. Major deals include the $8.4 billion acquisition of Smartsheet and Silver Lake's purchase of Endeavor. These firms use a strict benchmark known as the Rule of 40 to judge health. The Rule of 40 states that a company's growth rate plus its profit margin should exceed 40%. If a public firm fails this, a PE firm might step in to overhaul its operations away from the public eye. This retooling process often involves deep operational changes that public investors wouldn't tolerate. It might mean cutting unprofitable divisions, restructuring debt, or making massive long-term bets. Once a company is retooled and hitting its targets, it might stay private for another decade. The convergence of private equity and venture capital has created a new hybrid model of ownership. We are seeing the rise of semi-liquid evergreen funds that allow for indefinite private ownership. This means a company could technically grow to $1 trillion valuation without ever being public. For the first time in modern history, the public part of public company is becoming optional. The number of U.S.-listed companies has dropped from 8,000 in the late 90s to about 4,000 today. Meanwhile, the unicorn board continues to explode, creating a massive divergence in where value lives. This trend isn't just limited to the US, it is happening in Europe and across Asia. ByteDance, the parent company of TikTok, remains private despite a valuation of over $200 billion. The global private hegemony is making the public markets look like a secondary choice. This shift has profound implications for the average retail investor and the broader economy. Wealth creation is being increasingly concentrated in the hands of institutional investors. If the most explosive growth happens in private markets, retail investors are excluded from the best gains. By the time a unicorn hits the public market today, it is often a mature asset, not a growth engine. The launchpad model of the 90s allowed ordinary people to build wealth alongside the founders. The liquidity event model of today means the public often gets in when the founders are already rich. This contributes to a growing wealth gap, as the best investment opportunities are accredited only. The public stock market is becoming a retirement home for innovation rather than its birthplace. Ordinary people are left with unloved public assets, while the elite trade private unicorns. This two-tier financial system is creating a structural barrier to wealth for the middle class. As we look toward the end of the decade, the private-first mentality seems firmly entrenched. The infrastructure for private growth, from megafunds to secondary exchanges, is now permanent. While interest in AI and biotech might occasionally reopen the IPO window, the rules have changed. The reverse IPO isn't just a reaction to a bad market, it's a fundamental rewriting of capitalism. As more unicorns choose privacy over publicity, we must ask, what is the purpose of the public market? Is it to fund innovation, or merely to provide a graceful exit for those who already won? The finish line has moved, and for the world's biggest innovators, the future is increasingly private. The public ticker was once a badge of honor. Today, it is often seen as a burden to be avoided. As companies stay private longer, the public market is forced to reinvent itself or face irrelevance. Understanding these shifts is key to navigating the complex financial reality of the 21st century. The unicorns are choosing their own path, and the world of finance will never be the same. The Wall Street of the future might not be on a public exchange at all. It might be a private network of algorithms, evergreen funds, and secondary trade desks. Thank you for joining us on this deep dive into the changing landscape of global finance. Stay tuned for more investigations into the forces shaping our economic and technological world. In the next chapter of corporate history, the biggest moves might happen behind closed doors. The reverse IPO is the quiet revolution that is transforming the wealth of nations. We'll see you in the next investigation into the hidden gears of the global economy. Until then, keep an eye on what's happening away from the prying eyes of the ticker. The future of finance is being written in the private ledgers of the world's newest giants. The end of the IPO era is just the beginning of a new, private-first global order. Good luck navigating the new rules of the game.